There is tax due this year on money you have not touched. No form is coming for it. Nobody is going to write to you. No envelope arrives in January. And the institution holding that money knows precisely what you owe and is under no obligation whatsoever to mention it. I am talking about savings bonds, Series EE, the ones somebody bought in the 90s and put somewhere safe. Here is what almost nobody knows about them, and it is the reason I am making this video. A savings bond earns interest for exactly 30 years, and then it stops. That part most people have heard. Here is the part they have not. On the day it stops, every dollar of interest that quietly piled up inside that bond for 3 decades becomes taxable income. Not when you cash it, that year, whether you cash it or not, whether you have looked at it or not, whether you even remember owning it. And the Treasury does not send you a form because the form only gets generated when they actually hand you the money. So the government's position is that you owe tax this year. And the government's practice is to tell you nothing until the day you walk into a bank, at which point they hand you a form covering every dollar at once, in whatever year that happens to be. And the mismatch is now your problem to explain. Now, before anybody panics, I am going to be straight with you the way I always am, because there are 2 versions of this circulating, and both are wrong. The first version says the government is hiding a tax bomb in your drawer to trap you. That is not what is happening, and I will show you exactly what is. The second version says, do not worry about it, just cash them whenever, it all works out the same. That one is worse, because it is not the same, and the difference between doing this well and doing it carelessly can run to thousands of dollars for a household with a decent stack of these. Here is the accurate version, and it is 3 things. 1. What actually happens at year 30? Which bonds are already past it, and how to find out in about 10 minutes whether this describes you. 2. Why the income tax on that interest is only the first of 3 separate hits, and the other 2 arrive later and catch people completely unprepared. One of them does not show up until 2 years afterward. 3. The single decision you actually control in this whole situation, which is worth real money and which disappears permanently on a date you probably cannot name. And I want to say something at the outset that matters more than anything else in this video. This is not lost money. Nothing has been taken from anybody. Every dollar of it is still there and still yours. What is at stake is how much of it you keep, and that turns almost entirely on timing, and timing is the one thing in this entire subject that is completely in your hands. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because the decision in the third part of this video is only available before a bond reaches 30 years, and after that, it is gone for good. Let me start with how these things actually work, because you cannot make a good decision without it. A paper Series EE bond bought between 1980 and 2012 was sold at half its face value. If you paid $25, the bond said $50. That is the first thing that confuses people, because the number printed on the front was never what anybody handed over. From there it earns interest, month after month, and the interest is not paid out to you. It accumulates inside the bond and raises what the bond is worth when redeemed, and that interest is not taxed as it accumulates. That is the whole appeal, and it always was. Money growing year after year with nothing owed on it. Most people who bought these never made the alternative election to report it annually, so the tax simply sat there, deferred, decade after decade. But the law does not let that continue forever. Interest stops at 30 years. That is called final maturity, and at that moment the deferral ends and the entire accumulated amount becomes reportable income. Now let me give you the dates, because this is where you find out whether it is you. Series E bonds, the older ones without the second E, have all reached final maturity. Every one of them. If somebody in your family has those, the tax event already happened, possibly years ago. Series HH bonds have all matured as well. And Series EE bonds run on a rolling 30-year schedule. Ones bought in 1996 reached final maturity during this year. Ones bought in 1997 reach it next year. Everything bought before that has already crossed the line, some of it a long time ago. 1996 was a heavy year for these. They were a standard gift. Grandparents bought them for grandchildren. Employers sold them through payroll deduction. People bought them as the safe corner of a retirement plan, precisely because they were the least risky thing available. which means there are a lot of households right now holding bonds that quietly stopped earning anything at some point this year, sitting there doing nothing, with a tax obligation already attached. And I want to name something about that because it is the part that annoys me most. A bond past final maturity is not just a tax problem waiting. It is dead money. It has stopped growing entirely. It sits at the same value forever. So somebody holding one has already had the taxable event, is earning nothing further, and in most cases has no idea about either half of that. And it is worse than standing still, because standing still is not neutral. Prices keep moving. A bond that stopped growing in 2015 has been quietly losing purchasing power every month for a decade, while its owner felt good about owning it. The number on the redemption table has not changed. What that number buys has. That is the actual cost of not knowing about this, and it is far larger than the tax question for most families. The tax was always coming. The decade of nothing was avoidable. Let me tell you about Loraine. Loraine is 81. When her husband was working at the mill, they bought bonds through his payroll every fortnight for years. It was not a strategy, it was just what people did. A little came out of each check, and a bond arrived in the post. They are in a metal box in her wardrobe with the mortgage papers and the photographs. She has never cashed one. She thinks of them the way a person thinks about a savings account they are proud of. Her plan, spoken out loud to her daughter more than once, is that the bonds are for the grandchildren. The oldest of them stopped earning interest before her husband died. Some of the others crossed the line more recently. Not one of them is growing by a penny, and there is at least one tax year in the past where a number should have appeared on a return and did not. She has not been careless with a dollar in her life. She has simply never been told that the thing she was proud of had an expiry date printed nowhere on it. That is the whole reason the Quiet Rules exists. Plain English, printed large enough to read without hunting for your glasses, on the handful of things that quietly decide what happens to your money. What stops earning and when? What triggers a bill without anybody notifying you? And the order to do things in so the timing works for you rather than against you. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. So here's a question worth sitting with. Do you actually know the issue dates on the bonds in your house? Now the second thing, and this is where most coverage of this subject stops far too early. When a large amount of interest lands in one tax year, the income tax on that interest is only the first hit. There are two more behind it, and they are the ones that surprise people. The first hit is the obvious one. That interest is ordinary income at your regular federal rate, not the lower rate that applies to long-term investment gains. Ordinary income, the same as a wage. There is one piece of good news in it, and it is real. Savings bond interest is entirely exempt from state and local income tax. So if you live somewhere with an income tax, that portion never applies. It is federal only. Now the second hit, and this is the one that catches people who are otherwise careful. More of your Social Security can become taxable because of it. Here is how that works. The government calculates something called your provisional income, your other income plus tax-free interest plus half of your Social Security. If that figure crosses $25,000 for a single person or $32,000 for a married couple filing together, part of your benefit becomes taxable. Cross the higher thresholds, and up to 85% of it can be. A large lump of bond interest goes straight into that calculation. So a household sitting comfortably below the line all year can be pushed over it by cashing a stack of bonds in December. And the result is not just tax on the interest, it is tax on a portion of Social Security that was not being taxed at all before. That is the multiplier nobody mentions. One decision, two tax consequences. And the third hit does not arrive for 2 more years, which is why almost nobody connects it to the cause. Medicare premiums are income tested, and the test runs on a 2-year delay. What you pay for Part B and for prescription coverage in a given year is based on the tax return from 2 years earlier. So a large amount of interest reported this year does not affect this year's premiums at all. It affects the premiums 2 years from now. And when that increase turns up, it arrives with no explanation attached to it, long after the bonds were cashed and forgotten about, and the person paying it has no idea why their premium jumped. The standard Part B premium is $202.90 a month right now, and the surcharge tiers above it climb steeply. A single unusual year of income can push somebody up a tier for 12 full months. So think about what that means for a household with a serious pile of these. Ordinary income tax on the interest, a slice of Social Security becoming taxable that was not before, and a Medicare premium increase arriving 2 years later that nobody links back to the cause. 3 hits from one metal box in a wardrobe. Now the third thing, and this is the useful part, so stay with me. You cannot avoid the tax. I want to be completely honest about that because there are people online selling the idea that there is a trick here and there is not. The interest is taxable. It was always going to be taxable. Nothing makes it disappear. What you control is which tax year it lands in, and that one decision, made well, is worth real money. Here is the mechanism. The taxable event is triggered by the earlier of 2 things. You cash the bond, or the bond reaches 30 years, whichever comes first. Which means as long as a bond has not yet hit 30 years, you have a choice. You can cash it now in this tax year, or wait and let it land in a later one. You are choosing the year. And that matters enormously because tax is not charged at one flat rate. It is charged in bands. A year where your other income is low has room in the lower bands. A year where you took a large distribution from a retirement account or sold a property has no room at all, and the bond interest stacks on top of everything else at your highest rate. So the strategy is straightforward and almost nobody does it. Look at which years ahead of you are light, the year you retire before your benefit starts. A year with no large withdrawals planned. A year before you turn 73 and mandatory retirement withdrawals begin. Those are the years to put this income into. And if you hold a lot of bonds with different issue dates, you do not have to do it all at once. You can cash some this year and some next year, deliberately, spreading the income across bands rather than piling it into a single spike that pushes you over every threshold at the same time. That is the entire opportunity in this video. And here is the sentence that should make you go and look at your dates today. It only exists before the bond reaches 30 years. Once it is past final maturity, the taxable event has already occurred. You cannot choose the year anymore. It was chosen for you, by the calendar, in a year you may not even have noticed. So the bonds that still have time on them are the ones where you have a decision worth making. The ones already passed are a different job entirely, and that job is cleanup. Before I go further, you need to know what these are actually worth, because you cannot plan around a number you do not have. The Treasury publishes a free calculator on its website for exactly this. You put in the series, the denomination printed on the front, and the issue date, and it tells you what that bond is worth today and what portion of it is interest. That interest figure is the number that matters because that is the taxable part. Your original purchase price is never taxed. You already paid tax on that money when you earned it. Do that for every bond before you make any decision at all. 10 minutes with a calculator and a stack of paper turns this whole subject from a vague worry into a column of numbers you can actually plan around. Now, 3 specific windows where this decision is worth the most, because these are the ones people walk straight past. The first is the gap between retiring and starting Social Security. For a lot of people, that is a stretch of 1, 2, sometimes several years where income drops to almost nothing before the benefit begins. Those years have enormous room in the lower tax bands, and most people spend them living carefully off savings and paying almost no tax at all. That is the single best window in an entire lifetime to pull income forward deliberately, and almost nobody uses it because it feels wrong to create a tax bill in a year you were finally not paying much. The second is before you turn 73. At 73, mandatory withdrawals from retirement accounts begin, and they do not ask your permission. From that point on, every year has a floor of income underneath it that you cannot switch off. So a bond cashed at 71 lands on top of far less than the same bond cashed at 75. And the third is the hardest one to talk about and the one that costs the most, so I'm going to say it plainly. When one spouse in a married couple dies, the survivor generally files as a single person from the following year onward. The tax bands for a single filer are roughly half the width of the bands for a couple. So the same income, in the same household, on the same money, gets taxed considerably harder the year after a death than the year before it. Which means a couple holding a large stack of bonds, planning to deal with them eventually, are carrying a decision that becomes markedly more expensive the moment one of them is gone. And the surviving spouse is then handling it alone in the worst year of her life, at the higher rate. I am not raising that to be grim. I am raising it because it is the single strongest argument for doing this while both of you are here and can sit down at the table together, and nobody ever says it out loud. Let me tell you about Wilmer. Wilmer is 68, and he did everything a careful person does. He kept his bonds in order, he knew roughly what they were worth, and he had decided in advance that he would cash them when he retired. He retired in the spring. That autumn, he also converted a chunk of a retirement account because a newsletter he trusted had made a good case for doing it. Both of those things landed in the same tax year. The conversion filled the lower bands, and then the entire accumulated interest from 22 years of bonds stacked on top of it at the highest rate he has ever paid in his life. If he had cashed the bonds that year and done the conversion the next, or the reverse, the total would have been substantially lower. The same money, the same decisions, 12 months apart. Nobody advised him badly. Two people advised him well about two separate things, and neither of them knew about the other, and the collision happened in a place where no one was looking. That is precisely what this guide exists for, not to make anybody an expert in the tax code, to put the sequence in one place so a person can see what stacks on top of what before they act, rather than finding out in April that two good decisions canceled each other out. Same place, kevinexplains.shop. Link in the description and in the pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no argument. A man who did two sensible things in the same year and paid for it at the highest rate of his life. Now, inherited bonds, because a great many of you are holding bonds that were never yours to begin with, and the rules there are different and more forgiving than people expect. When somebody dies holding savings bonds with deferred interest, that interest does not vanish, and it does not get reset. It carries forward. In the tax world, it is called income in respect of a decedent, and what it means in practice is that whoever ends up with the bonds eventually owes tax on all of the interest, including everything that accumulated during the original owner's lifetime, going back to the day it was bought. So a grandson who inherits a bond his grandmother bought in 1992 can end up paying tax on 30 years of growth he had nothing to do with. Now here is the piece that is worth knowing, and it has a deadline attached to it that most families blow straight through. The person handling the estate can elect to report all the accumulated interest on the deceased person's final tax return. That is allowed, and in a great many cases, it is the better outcome, because a final return frequently covers only part of a year and often has low income in it. So the interest lands in a return with room in the lower bands, rather than stacking on top of a working beneficiary's salary. Once that final return is filed without the election, that door is closed. And final returns get filed by people who are grieving, quickly, by whoever is available, and the question never comes up. So if somebody in your family has died recently holding savings bonds, that is a question to raise with whoever is preparing the final return, and to raise this week rather than next month. And there is one more piece of relief that applies where the estate was large enough to owe federal estate tax. In that situation, the beneficiary can claim a deduction for the estate tax attributable to that interest, which prevents the same money being taxed twice over. It only applies to larger estates, but where it applies, it is worth a substantial amount, and it is routinely missed. Two more things about inherited and jointly held bonds, because the names printed on the front matter more than people realize. Look at how each bond is registered. Some say one name only. Some say a name, then the word or, then a second name, which makes both people owners. And some say a name, then payable on death, then a second name, which makes the second person a beneficiary rather than an owner. Those three registrations behave completely differently when somebody dies, and they determine who has to do paperwork, who can simply walk in and cash it, and whose tax return the interest belongs on. A bond registered with a co-owner can generally be redeemed by the surviving co-owner without any estate process at all. A bond in one name only usually cannot. So take 5 minutes and read the front of each one properly, rather than just noting the date. If a bond is in one name and that person is elderly, adding a co-owner or a beneficiary is a straightforward reissue that saves whoever comes after a considerable amount of trouble. And be aware that a reissue can itself be a taxable event in certain circumstances, particularly where ownership genuinely changes hands rather than simply adding a beneficiary. So it is worth asking before doing it, rather than discovering it afterward. All right, practically, how do you actually deal with all of this? First, find them, and that means physically. A metal box, a safe deposit box, the back of a filing drawer, the envelope in the bureau nobody has opened since a funeral. While you are there, look at the issue date on each one, which is printed on the face. That date plus 30 years tells you everything. Past that, it stopped earning and the tax event has happened. Before it, you still have a choice. Second, if you think bonds exist but cannot find them, the Treasury runs a search tool for exactly this. It looks for bonds that were never delivered or that have matured and never been cashed, matched to a name and a social security number. It costs nothing to search, and people find money in it regularly. Third, if a bond is genuinely lost or destroyed, there is a form for it, FS Form 1048, the claim for a lost or stolen bond. And one detail worth knowing, if the bond has already reached final maturity, they do not replace it with a new bond. They simply pay you what it is worth. Fourth, cashing them. A bank will often do it, but many banks limit how much they will redeem for a customer in one visit, and some will not handle paper bonds at all anymore. If your bank will not, or the amount is large, you post them to the Treasury's Retail Securities Office with the appropriate form, and they pay you directly. Do not sign the back of a paper bond before you get to whoever is redeeming it. They need to watch you sign. Fifth, and this is a small thing that saves a real headache. If a bond already reached final maturity in an earlier year, and you correctly reported that interest then, and you cash it later, the form you receive will show the whole amount again as though it were new income that year. It is not. There is a way to handle it on the tax return by listing the amount already reported previously as a separate line on Schedule B, so you are not taxed twice on the same dollars. Tell whoever prepares your return that this applies before they start, not after. And there is one exclusion worth mentioning, even though it fits few people. If the bonds were issued after 1989 and the owner was at least 24 when they were bought, and the money goes to qualified higher education costs in the same year, the interest can be excluded from income entirely, subject to income limits. The form is 8815. It is narrow. For a grandparent paying tuition, it can be worth a great deal, and it is worth 10 minutes to check whether the conditions fit. Let me tell you about Ardith. Ardith is 73, and she found 4 bonds in a shoebox after her sister died, made out to their mother, dated 1987. She assumed they were worthless, old paper, something to keep for sentiment. She nearly put them back in the box. They were worth several $1,000s, and they had stopped earning anything years before she ever laid eyes on them. And they had been sitting in a shoebox in a spare room, losing value to inflation the entire time. She got the money. What she did not get was the 14 years of growth she would have had if anybody had known to look, and she will never get that back. And nothing whatsoever was stopping her, except not knowing there was a reason to check. Now let me give you my honest opinion, which is only that, and you are welcome to disagree with me in the comments. I do not think the Treasury is doing anything underhanded here. The rules are published, the maturity dates are printed on the bonds, and the tool to check values is free and on their website. And the deferral itself is a genuine benefit. Decades of growth with no tax owed along the way is a real advantage, and it was the whole reason these were attractive. Nobody was tricked into a bad product. My objection is about the notice, and it is narrow. Every other institution holding your money tells you when something happens to it. A bank sends a statement. A brokerage sends a statement. A retirement account sends a statement. If a certificate of deposit matures, somebody writes to you because they want to know what you intend to do next. A savings bond reaching the end of its life is the single largest event in that bond's existence. It stops growing forever, and it creates a tax obligation the same day. And nothing arrives. No letter, no form, nothing at all. Unless the owner happens to have registered an electronic account they most likely never set up because they bought paper bonds in the 1990s. So the burden of noticing sits entirely with a person who was, in most cases, given the bond as a gift and never told it had a clock on it. And that is the same pattern this channel keeps running into. Not concealment, just the complete absence of anybody whose job it is to tell you. And I want to add one more thing because it would be dishonest to let this video end sounding like these were a mistake to own. For the people who bought them, savings bonds did exactly the job they were sold to do. They never lost a dollar. They never required a single decision. They came through every crash of the last 40 years without the owner having to think about it once. There was a whole generation who put money away in the only instrument they completely trusted, and it was there the entire time. The failure is not in the product. It is that the product ends, and the ending is silent, and the person holding it is now 30 years older than they were when somebody put it in their hand and told them it was safe. So if there is a stack of these in your house, the right feeling about them is not regret. Somebody in your family made a careful decision a long time ago, and it worked. The only thing left is to finish it properly. And there is one more thing I have to say before the checklist, because a video like this one creates exactly the conditions somebody exploits. Nobody legitimate is going to telephone you about your savings bonds. Not the Treasury, not your bank, not a government office. There is no service that recovers them for you, no fee that speeds anything up, and no company authorized to handle your bonds on your behalf for a share of what they are worth. The search tool for missing bonds is free, and it is on the Treasury's own website. Redeeming a bond is free. The forms are free. If anybody contacts you offering to locate, unlock, expedite, or protect your savings bonds for money, that is a person trying to take them from you, and the paper in your hand is the only thing they need. So do not read the numbers off a bond to anybody who telephoned you. Do not post them anywhere. And if you are unsure, take the bonds physically into a bank you already use and ask a person you can see. All right, here is your list. 5 things, and the whole thing fits in an afternoon. 1. Find every bond in the house and write down the issue date on each one. Add 30 years to each date. That single column of numbers tells you which ones are dead and which ones still hold a decision. 2. For anything past 30 years, cash it. It is earning nothing, and every month it sits there it loses ground to inflation while the tax has already been triggered. 3. For anything still inside 30 years, do not cash it on autopilot. Look at which of the next few years is lightest for you and put the income there deliberately. If you hold a lot, split them across years rather than doing it all at once. 4. If somebody in your family died holding bonds and the final return has not been filed yet, raise the election question with whoever is preparing it this week. Once that return goes in, the option is gone. 5. Before you cash anything substantial, work out what it does to your provisional income, and remember the Medicare premium test runs 2 years behind. One conversation before you act is worth more than any amount of explaining afterward. And if your own situation is tangled, if you are holding a handful of these and cannot work out which year to put them in, write to me. The address is on your screen and in the description below, and I read every one that comes in. Tell me the issue dates and the denominations, because those are the 2 things I will need before anything else. One last thing before you go. Loraine is proud of a box of paper that stopped growing years ago and is quietly worth less every month she keeps it. Wilmer did 2 sensible things in the same 12 months and paid a rate he had never paid in his life because nobody was looking at both decisions at once. And Ardith nearly put several $1,000s back in a shoebox because she assumed old paper was just old paper. None of the 3 did a single thing a reasonable person would not have done. Not one of them was cheated by anybody. Every one of them was holding something with a clock in it that nobody ever mentioned. So go and look this week, while there is still a choice to make on at least some of them. Find the dates, do the arithmetic, and decide which year this lands in yourself, rather than letting a calendar decide it for you in a year you did not even notice going by. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.